Hello everyone, hope you guys are doing well today. Now, today we are basically going to focus on section B. Okay. Now, section B of the pre-mock mainly focuses on a mixture of questions. Multiple areas are tested here in terms of the obligations of an auditor in accordance with ISA 250. We have some other areas such as anticipated, one question on audit planning, one question on substantive procedure, one question on our audit report. Not a part on audit report, but one of the main questions was on test of controls and direct controls. Now, if you just straight go forward towards the question, the first question is of 30 marks. So let's see what the question is emphasizing on. Now, in this first question, what does it say? The first part says, describe the responsibilities of black company in relation to either 250 consideration of law and regulation in an audit of financial statements. Now, first of all, when you are looking at the particular situation of consideration of laws and regulations, what is the main agenda here? You are trying to see your position as an auditor, that what are the expectations from you in terms of in the laws and regulations of the auditing standards. Now, this first question is of 4 marks and you don't need to refer to the passage for this. So we are directly going to answer this. Now, describing the responsibilities. First of all, what is the primary duty of an auditor? The primary duty of an auditor is to provide true and fair picture on the financial statements, or give an opinion whether the financial statements present fairly in all material respects. Okay. Now, an auditor has no responsibility to make sure that the company is having no frauds. The auditor has no responsibility to prevent non-compliance. The auditor has no responsibility in terms of implementation of controls. Now, what is the responsibility of the auditor? The responsibility of the auditor is that he must consider whether any kind of non-compliance is going to impact the financial statements. Anything impacting the financial statements will be taken into account by him. Okay, so the main responsibility of the auditor is to understand any impact on the financial statements. Now, coming back towards what is the responsibility. Now, if you're talking about responsibility, is the impact material in nature or not? Now, first of all, if I want to understand the impact of something, what do I have to do? I have to basically understand the laws and regulations that are specific to the industry that we are in, right? We have textile, we have electricity, we have EV vehicles. Now, multiple regulations are there in terms of each of the particular components of the financial statement or components of the industries, right? So what is the objective here? The first duty of the auditor is that he should be in the position to understand the laws and regulations, the impact of the particular laws and regulations, whether they are directly impacting the financial statements or whether they are having an indirect effect on the financial statement. Okay, so first thing you will highlight is that the auditor has no responsibility in terms of prevention of the company from non-compliance, but his responsibility is concise towards only checking if any non-compliance is affecting the financial statement. Okay, now next, moving forward towards which laws are affecting the financial statement directly. That means basically tax laws. They can be pension regulations. They can be some unions. They can be some kind of provisionally laws that are there. There are some laws in terms of the local legislation that can directly impact the financial statements, right? So because these laws directly impact the figures of the financial statements, like the taxes, the provisions, etc., etc. Now this will be a first focus of the auditor. Okay, the auditor will be first focusing on areas directly affecting FS. Okay, that means basically any law that is going to impact the figures of financial statement is the first focus of the auditor. So he will obtain understanding of those laws and regulations. He will seek compliance, whether the company is complying with them or not. He will perform substantive procedures for the compliance checking as well. Then he will obtain sufficient appropriate audit evidence that the company is in compliance or not. And if there are non-compliances, what may be the result of the non-compliance on the financial statements? That is what we are trying to identify. Okay, now first area is direct, the second area is indirect components. Any indirect areas where our financial statements can be affected. Now, if there is a breach of a particular law or regulation, it could indirectly affect our financial statements, such as environmental laws, right? If environmental laws are breached, does environment have a direct impact on the financial statements? No, it does not, right? It is not included in the financial statements. But because of a particular area, a breach of law in terms of environment, we have a fine that is in the financial statements, or provision that is indirectly affecting a financial statement. So impacts of things that are immaterial or material but are indirect in nature. So first focus will be that go for direct areas, the direct components of financial statements, such as interest rates, taxes, etc. Next thing, go for indirect areas such as health and safety laws, any union laws, regulatory breaches, licenses, trading absolute trading license that we have importing licenses, we have credit authorities, etc., etc. Okay, now what do we have to do is we have to understand that whether the impact will be material or not, and how does it have a representation of financial statements? How does it need to be recorded? Like in IS 37, there is a provision. Now we have to consider whether this is a claim upon us, whether it is possible, probable, or remote, right? So in accordance to that situation, we are going to record a provision or a contingent liability or just a disclosure or do nothing, right? So understanding the nature of the indirect impact is our responsibility. Now, other than that, what is the auditor required to do? Auditor is required to obtain understanding of any causes of breaches that we have and would impact our financial statement directly or indirectly. Plan for the checking of those non-compliance. If those laws and regulations are specialized in nature, then hire a auditor's expert in terms of this area so that he can advise the auditor on better grounds, right? If you find any kind of laws and regulations that are there, discuss with the legal team of the company or the client to understand whether the company is complying with them or not. And if they are complying with them, how are they complying with them? What are the legal grounds that we have to focus on? Then remain alert throughout the audit for any non-compliance that may come to your attention so that you are able to understand it. Now, we are going with the flow, right? First of all, what is compliance? What is the responsibility of the auditor? Then responsibility towards direct impact, then indirect impact. And what will be the responses? Now, responses is not the last area. Okay. After responses, what the responses that we have identified, what are the impacts of the responses, or how do we identify or report these particular areas to responsible parties, right? If there is a particular situation where a breach is there, report significant breaches to the management that there is a significant breach and you might not be able to take care of it in long term. If there are significant breaches, communicated to TCWG, the audit committee as well. If there are some breaches that are to be reported to external regulatory authorities such as money laundering or fraud, etc., etc., if you are legally required to do so, report them as well. And at the max circumstance, if the company is not complying with accounting treatment of the particular non-compliance, if non-compliance is there and the management is not dealing with them or rectifying them in the financial statements, then you can go for the particular modification of the audit opinion as well. So very knowledge-based question. This is commonly given in my notes as well, the complete details of ISO 250. The main thing that you have to focus on, what is the responsibility of the auditor? That is one of the main points. And what are directly impacting areas? What are indirectly impacting areas? What is the responsibility of the auditor if he identifies a non-compliance? How does he proceed about in terms of the complete audit engagement towards the non-compliance or susceptibility of non-compliance? Okay, so understanding the situation, understanding the industry, and acting in accordance with the testing to be done so that our financial statements don't get a negative impact. Okay, that is our main responsibility here. No, this is a 4 marker. If I have discussed approximately 5 points with you, so if you are able to draft them, it will be more than enough for you. Draft these 4 points. These are knowledge based. It has nothing to do with the relation of the passage. Okay. Now moving towards the next area, that is again a repetitive thing, a thing that has been there always. A question is expected to be there and will always be there. You cannot say that this is a thing that is unique for you or new for you. This is a question that is always going to be there in the examination. So audit risk and responses to audit risk. Now, first of all, how do we answer audit risk question? In audit risk question, first of all, identify the risk, explain the risk, and write the impact of the risk. So identification, explanation, and impact. Three things for audit risk. A recommendation or response. Now, response here is that whether it is affecting the complete financial statements or is it affecting one of the components of financial statements and assertion of financial statements. If it is it is a situation that the complete financial statements are impacted, then what are you going to do? You are going to basically go for a change in strategy. If it is affecting one of the components, one of the areas of financial statements, then you are going to perform more substantive procedures. So that is the main thing that you are going to do. So your response will depend on whether you identify the level of impact it brings on the financial statements. If it is a small impact, then go for the assertion level responses, or if it is a big impact, it is covering the complete financial statements, go for the overall financial statements. Now, we have to write 8 audit risks. I'm going to discuss each and every possible outcome that we have, a possible situation we have in terms of audit risk and responses. So let's read them. Now, planning meeting notes. Now, during the year, company has spent heavily on research and development. Okay. Several new online courses have been developed. This is the first time company has done R&D. Now, first of all, if a company has done R&D on the first time, on the first basis, is this a risk? Yes, it is a risk. Why is it a risk? Because we are new to this situation. If we are new to a situation, the accounting treatment will be complex to us, new to us, so we don't have any adequate experience in terms of recording these things or dealing with these things. Okay, so this is going to result in a audit risk that the company might not be able to record everything on true and fair grounds because they don't have adequate experience for it. Now, let's read the complete paragraph so that we are able to answer this adequately. Now, the finance director has confirmed that all R&D work is likely to be successful, and so he is intending that the capitalization of all R&D expenditure is expected to total to 1 million by the year end and intangible assets. Now, first of all, we have no experience. This is a problem. This is a deficiency. Other than that, we are saying that every particular option, every particular situation, in terms of the researches that we're doing, is going to be converted. Okay, every possible thing that we have thought is or we are researching upon will be converted into market conditions. Now, first of all, what does IS 38 say? IS 38 says that if a particular area is researched, when can we basically record the particular cost as development cost? There are 6 criteria for it. What were the criteria? First of all, technical feasibility of completing the assets. We have a technical feasibility of completing the asset. We have intention to complete the asset for use or sell. We are seeing a potential use of the asset for economic benefits. We have probable economic future benefits here. Availability of adequate technical and financial resources in the company. Other than that, we have our ability for reliable measure of the expenditure. So all of these things are there. If all of these things are there, that means basically we can reliably estimate the expenses and we can see that these 6 criteria are to be complied with. So the risk here is that the company being new to this system might not be able to apply all these particular conditions. And if these conditions are not met, we might overstate our asset and understate the expenses that are there in our financial statement. So in this particular point, what you have to basically identify or answer is number one, not compliance with IS 38 or no experience. First of all, we can write this. No experience. So mistreatment is having a higher chance here. Now, research cost must be expensed out and only development cost must be capitalized, right? And capitalization criteria is 6 criteria according to IS 38 that we normally know as pirate. Okay, so the risk here is that the company might have a particular situation where they overstate asset and understate expenses, leading to a higher profit in the financial statements as well. Okay, so how can we basically drive this answer or draft this answer? We can basically say that first of all, give the heading of capitalization of R&D expenditure, then write that all of the expenditures of R&D are capitalized on the intangible assets. The statement from the passage. Then explanation, why is it a problem? That it is a problem because assets that are only in development phase, their cost should be capitalized, the revenue expenditures, the research expenditures should be expensed out. Okay, now you have explained that this is the treatment that should have been done, and they have done this particular treatment that they have capitalized everything. Now, if you have told them why is it a problem, then what will be the impact here? Now, the impact here will be that the intangible assets might be overstated, the expenses might be understated, and the profit might be overstated as well, right? This cost is enhanced. Why? Because we have no prior experience to these treatments. So this is a audit risk for you. Now, what can we do about it? What can we do about it? If this is a risk, is this risk covering the complete financial statements or one or two assertions or one or two components of financial statement? it's only affecting intangible asset and expenses, two areas of financial statement. So we will not say that this is the level of risk that is coming on the audit report. So here what we are going to do is we are going to perform substantive procedures. What are we going to do? Our objective here is that we are going to only classify, or we are going to try to identify whether the company has classified all the expenditures on the asset. So first of all, we are going to obtain details of R&D cost, that is from the invoices or other documentations, to identify what the cost has incurred upon. Then inspect the board minutes. So board minutes will tell us that whether the treatment is according to what situations. Then cash flow forecast can be there for our now what can we do is now just cutting the points off, giving you a help regarding the particular substantive procedures. If you are going for substantive procedure for R&D, if the examiner asks you some substantive procedures in terms of research and development, it is the most easiest point for you. Why? Because there are 6 criteria of assessing whether the company is complying with, or whether the cost should be capitalized or not. Check each of the particular components. Like let's say, if I say there's a technical feasibility to complete the asset, I will have a feasibility report. Check the feasibility report for future completion or user usage of the asset, right? If they are saying the company will have future economic benefits, the future economic benefits will be assured or extracted from where? From future cash flows. So future cash flow statement can be checked and assessed for reasonable estimations. Other than that, if we see that we have technical feasibilities, we have a feasibility report, we have a technical report, we have the resources report within the company, we can discuss it with the management. So all of the 6 criteria of pirate can be tested here, and we can write substantive procedures according to them. So here also we can write substantive procedures in terms of the 6 criteria. We can discuss with the board minutes, check the board minutes to identify the completion intent of the management, cash flow forecast and feasibility reports, market research. All of these documents will give us evidence whether the particular research is going to be converted into a final product or not. So whether the cost should be developed, or cost should be forecasted, or cost should be capitalized on the asset or not, right? Then ensure that the revenue expenditure is expense and capital expenditure is capitalized, and the asset is qualifying the criteria. So with this, we can easily write 5 to 6 substantive procedures in this area. Now, moving forward to the next area, next paragraph, what does it say? To help fund this R&D expenditure, the company took out 1.4 million loan in February at an interest of 7% per annum. The loan is being repaid in quarterly installments that started in May 2005 and will end in February 2009. Do we find any kind of risk here? Yes, we do. Why? First of all, if we are having a loan taken out, the loan is taken out on which date? It's taken out in February. Okay, what is our year end? Our year end is July. Now they are saying that we are paying our loan in 4 installments now, quarterly each year, quarterly each year. Now, if we are paying a non-current liability within this year, should we segregate the classification of the loan in terms of non-current and current? Yes, we should. So the 1.4 million is to be classified into current liability and non-current liability both. Why? Because non-current liability is a thing that is not going to be there for current positions. There is no current outflow of cashes. So classification will be the issue here. So the amount that is to be paid within this year is to be classified as current liabilities. The interest that is to be paid within this year is to be known as current liabilities. The ones that are not paid this year should be recorded as non-current liabilities. So first of all, identify the statement. Loan received in mid-year in February 2009. Now, if we have received the loan on 9 February, the risk here is that interest expense is incorrectly accrued. Okay, because we are paying it, and risk liability is not correctly split between current and non-current liabilities, right? So what should be the particular response? The response should be that this is a risk that is coming in one of the areas of financial statements. So what are we going to do? We are going to perform substantive procedures. Substantive procedure involved that first of all, inspect the loan agreement and see whether the particular the particular interest rate is what 7% or not, right? They have told us the interest is 7%, so we will check the agreement for that. Then we will recalculate the interest income or interest expense that we have and compare it with what we have recorded in the financial statements. Then we will recalculate the payment schedule and split it between current and non-current according to our estimations that we have had. Okay, so this is a thing that we have made clear. Now I'm going to answer any of the questions that you have Please drop them in the chat box. As soon as I'm done with one of the questions, I will be answering all of the queries that you have. Okay, so please wait for that. Now, next area, when customers want to book on to the online courses that Gomez company offers, they do so through the company's website and required to pay in full when the booking is done. All courses booking allow customers 6 months to access the course. Now, the duration of the particular course is 6 months. Please remember that. Now, starting from the date of the booking is made, the booking site is integrated with accounting systems, so all income from booking is credited to revenue as soon as the booking has to be made. Now what is the problem here? The problem here is we are recognizing our revenue early on, not accruing it according to the situations. Now, in accordance with IFRS 15, what is the treatment of revenue? The treatment here is that if a performance obligation is for 6 months, okay, and let's say the cost was $600 for each course, we should basically divide it for each month, and $100 should be recognized at the end of each month. Our first double entry here should be that we should record a particular cash debit, an entry of cash debit, and unearned revenue as a liability of 600 for each course. The 600 amount is an assumed amount. Okay. Now, this is the first entry of when the booking comes into us. After this booking comes in, after we are providing service, after 1 month, when we have provided service for 1 month, what should we do? We should basically record double entry here that unearned revenue debit by 100 and revenue or sales should be recognized by 100. Now, why are we doing this? Because our particular accounting treatment says that the revenue that you have earned, the performance obligation, when satisfied, then and then only you can recognize the revenue. But here we are recognizing the revenue as soon as it comes into our account. So this is a risk that our revenue will be overstated and the liabilities are going to be understated in this situation. Okay, so the risk is that our revenue is going to be overstated and deferred income or liability is going to be understated here. So is it a particular area, a component of financial statements? Yes, it is. So again, what will be the first situation? This will be that we are going to perform substantive procedures. Now, because the system is integrated, a software is integrated, right? What are we going to do? We are going to use audit softwares to identify that the booking is directly integrated with the accounting systems. Then we are going to do what? We are going to recalculate the deferred income based on the remaining access periods that we have. Recalculation or deferred income is the first area. Then ensuring that the revenue that is recognized is the one that is only earned by us when the performance obligation has been satisfied. And then verify the corrections, that whether they are made or not. If corrections are there, whether they are done by the management or not. If they have done the corrections, then we are going to recheck the corrections for adequacy. Okay, so this is one of the most important areas, one of the biggest areas that we can see. Now, in March 2005, company sales staff were informed that from 30th September year end, they would be receiving a bonus based on overall company revenue for the year. Now they are saying that they will receive a bonus based on company's profit. Now, what does the company have as a risk? What will the auditor think here? First of all, the auditor will think that when the employees or the sales staff are getting a bonus on their profits or sales, that means basically they have an incentive to inflate the sales, so incentive to manipulate the sales, incentive to commit fraud. So the risk here is that the company or the company sales staff might create fake invoices or fake customers to record fictitious sales so that they can inflate the revenue and get a higher bonus here. So the revenues are going to be overstated in this scenario. Okay, so this is also a bigger problem. This is a problem in terms of the complete revenue. But does it constitute towards a fraud as of yet? No, it does not. It is a risk here. So we are going to check it whether the particular revenue is overstated or not. Right. So first of all, what can we do? We can increase the sample size to test revenue to identify that this particular bonus announcement has it affected the revenues after the announcement or whether it was higher as of normal circumstances. Look, announcement is made if let auditor will think analytically. If the announcement is made on 1st February, after 1st February, if our sales revenue is rising substantially, he will have a hint that there is some kind of manipulation done here. If the revenue were higher and the employees are working hard, if the revenues are increasing but not at an extremely higher rate, then we can basically assume that this can be because of the incentive that we're giving them. So the professional skepticism and professional judgment is of key importance here. Then we will verify the occurrence of bookings with the goods delivery notes or the customer satisfaction reports or customer delivery reports, the watching of lectures. Now in this situation, we have a education-based system. In education-based system, I can relate to it. If I want to confirm that a student is there, I will check the portal that they are having the lectures watched or not, right? Now, then I will do what? That I will also check whether there is any kind of refunds after the investment has been made, the course is purchased. Now, think logically. If a person wants to inflate the sales, if he is posing as a fake customer, what will he do? The employee will do what? He will purchase the course. Okay, he will purchase the course, and as soon as the year end comes into account, when the financial statements are finalized, he will cancel the subscription. So check for frequent cancellation of subscriptions if there are any, and refunds are made. So if refunds are made and cancellations are done, that means basically we can find a hint of fraud here as well. So fraud can be easily estimated from this particular activity as well. Then we will perform detailed double entry testing so that we can check whether the revenue is recorded adequately, and the revenue that is recorded for a particular customer, we have the customer in place as well or not. Okay. Now, next paragraph. In June 2005, the director of Gomez Company received a letter from legal firm. So IS 37 automatically comes to your mind. For a competitor online training company claiming that Gomez courses have illegally copied their course content. So copyright infringement is the area that we are going to focus all upon. Now claiming damages of 800,000. Director of Gomez Company believes they are likely to suffer reputation damage if the claim continues, so are considering trying to settle it out of court. Now, what is the risk here? What do you think? Now, if we think logically, if we are trying to settle it out of the court, and we don't want it to go public, that means we are trying to avoid it being recorded in our financial statements as well. We will try to avoid the recording of this particular situation in our financial statements as well. And it is likely that we will fail. This means a particular probable situation is here. So a provision should have been recorded, right? So in order to settle this particular case, we are going to go out of court. So we are going to avoid the recording of the provision in the financial statement as well. This is the risk that we're going to face. So in this situation, what will be the impact here? The impact here will be that the liabilities in the financial statements are going to be understated here, right? Because we are avoiding the recording of the legal claim in our financial statements to avoid our reputational loss. Okay. So here in the situation, is it affecting the complete financial statements or one of the component? One component is it. Then we are going to do what? We are going to discuss with the director the legal claim and see what do they say. Discuss the claim with the legal advisors to identify the position of the claim. Inspect the correspondence with the claimant. What are the discussions done? Read the minutes of the board so that we can discuss, we can get the opportunity to understand what is the mindset of the management. Are they willing to record or not? Then assess the likelihood of the amount to be paid and recognize or ensure that, ask the management to recognize the provision. We are not going to recognize the provision ourselves. The management is going to do so. Okay. And if the management is going to do so, then we are going to check whether a particular provision is recorded. And if there is a contingent liability, if the likelihood is misinterpreted, we have no confirmations here as of yet. If the likelihood is lower, then ensure that our disclosure is present within the financial statement. Now, this particular situation is a classic example that we normally see, and not recording a provision to basically improve our reputation, and not writing a liability in the financial statements. So this is the thing that is our address as well. Now, as of this point, we have discussed 5 pointers. We have to write only 8. If we identify only 3 more within the next 4 paragraphs, it will be a brilliant opportunity for us. Okay. Now, let's move forward to the next paragraph. What does it say? The director of Gomez Company owns all shares of the company between them, and they are hoping to list the company on stock exchange within the next 2 years. To improve corporate governance, board has established a new internal audit department. Now, before we move forward, first of all, if the company is going for listing on a stock exchange, is there a risk in our company? Yes, there is a risk. What is the risk? The risk is that our company might show bias, right? A company's management might show bias if we have a particular listing coming up in the next 1 year or 2 year, whatever the time duration is. our company will try to inflate our profits, right? They are going to inflate our revenues, our deflate our expenses. Our expenses are going to be lower, our revenue will be higher, our profits are going to be try to look better off in the particular financial statements. Our liabilities are going to be omitted. There is a higher chance of that, so that when we list ourselves in the stock market, we have a very good reputation there, right? So reputation is one of the most important areas that is going to be focused here. So the listing gives us indication that there is a higher chance of manipulation in the financial statements. Now tell me one thing. If the listing is there, does listing affect the complete financial statements or one of the component of financial statements? It will impact the complete financial statement. So this is one of the example of risk, that is a financial statements level risk. Now in financial statements level risk, what are we going to do? We are going to basically modify the audit strategy. By strategy, what do we mean? We are going to appoint senior staff to test our areas. We are going to focus on procedures to check any overstatement of assets or revenues, or any understatement of liabilities or expenses. We are going to check more samples. So our sample size is going to be increased here. Substantive procedures are also going to increase there. Our materiality is going to be decreased here. Our overall agenda here is that we might not be able to detect the particular misstatement here. Now, the detection is going to be the main focus here, that we are trying to detect any kind of situations, any kind of thing that is there in the particular company that might affect the complete financial statements. Okay, so the risk of management override of controls is higher as well in this situation. So this brings us with two risks. First of all, inherent risk and control risk, both are impacted here. So if both are impacted, that means basically it will bring a material impact on the financial statements. So this is an area that is of key importance for us as well. Okay, many people ignore this, they just read it as information, but this means something for us. Okay, now the internal audit department set up to improve corporate governance. Internal audit staff has been testing the internal controls of the company throughout the accounting year, and the audit engagement partner is keen to rely on the test of conducted by the internal audit department. Now, first of all, should we rely on the internal audit department? Now, that is a question that you have to ask, right? There is a risk if a particular internal audit department is established. If a particular internal audit department is established, it should be independent in nature, right? It should be independent there. Now, first of all, independence is the thing that you have to check. Okay. Now, can the auditor rely on their work? It is a big question mark, right? Why? Because this will increase the risk of having a position where we might not be able to detect the risks available in the internal controls, the risk in the company, and our overall audit risk can increase here. The detection risk can be increased here. Okay. Now, the internal auditor might show bias. They might not perform well. They might not be experienced in there. This is a new department, so they might not be experienced there, right? We might have a position where they are not checking the correct areas, they are not performing the correct tests. So in this situation, we are going to have a loss. The audit risk is going to be substantially higher. At the end of the day, the audit reports, the response, the audit opinion that we're giving, the responsibility is ours, right? As auditor. So in this situation, reliance on internal audit department will be a risk for the engagement partner. So this is a risk that is going to disrupt our audit. Yes, it will. So is it covering the complete financial statement? Yes, it is, because our complete internal control testing is higher here. The direction risk is higher here. So what is going to be the change here? The change here will be that we are going to perform some of the additional tasks. The audit team will be told to check the particular internal controls themselves only and rely on the evidences obtained by them only. Then we are going to do what? We are going to do more things, such as check the qualification of the internal auditors, whether they're qualified to do so. Do they have experience of it in any other industries or any other departments? Are they independent in nature or not? Then what is the scope of the work that they are performing their test on? Okay, so all of these things are going to give us an indication whether the particular internal auditor department or internal auditors that are working can we basically take their work and basically go through it, or cast reliance on their verdicts that they have. Okay, so performing internal control testing is not an option in this case. Why? Because the department is newly established. A newly established department basically replicates that if a particular person, internal auditor, comes in the company, if he's in the company, he might have experience in other companies as well. but he's new in this company. If he's new in this company, he will have a higher detection risk here, right? So our external auditors should not rely on them solely. They should perform substantive procedures or test of controls themselves only as well, so that they can get a two-way confirmation of the particular reliability of the internal controls. Okay, so many people will think that internal control department is there. If we check the competence, the experience or their work, we can rely on it. But here they are new, so we have to perform the procedures ourselves as well. Okay. Now moving forward towards the next paragraph, Gomez company owns studio equipment which was purchased 2 years ago, and until now it has been depreciated using 3A straight line method. The finance director has informed the audit engagement partner that from this year, the useful life of the existing equipment has been extended to 6 years. Okay, because the equipment is lasting longer than expected, so depreciation charges on the asset are falling as a result of it. Now, first of all, is this a risk? Yes, it is a risk. Why? Now relate to some other things. Relate to one of the areas where we are told that we are going for stock exchange listings. If you're going for stock exchange listings, what is our agenda to show our financial statements in a better of position? Let's say if our asset was of $300. Previously, we were depreciating it at 3 years. That means yearly depreciation was 100. Now we are depreciating it at 6 years. That means our depreciation expense is reducing. If expense reduces, our profit is increasing. So profit increasing indicates towards a bias by the management. This strategy can be due to a biasness by the management, right? So what is the main response of the auditor? The response of the auditor is that first of all, check the reasonableness of this particular activity. Now understand one thing, that if someone is telling me that depreciation is reducing, if depreciation is reducing, what will be my thinking here? What will be my thinking here? If something is having a longer useful life, that means basically it performed well, right? If it performed well, that means it would have required less maintenance. Yes, it will be in a good condition. The productivity is not declining, right? So three areas that we can basically check. Now, if we have three areas, three substantive procedures can be easily checked here. So go physically check the condition of the asset so that we can get evidence that the asset is in condition to be depreciated higher or lower. Then we can go for what? We can go for the reasonableness of the estimations of a longer useful life by checking the particular maintenance log of the particular asset. We can check whether the productivity report shows a lower production or a higher production as of last year or the initial years, right? Now, if the a change in accounting policy or estimate is there, there is a requirement for a disclosure to be done. So we are going to check the disclosure as well. Then we are going to do what we are going to do. One more thing is that a depreciation method is changed. So it is changed for the complete line of the assets, the complete type of assets, right? So in this situation, a board discussion might be there as well. So a board discussion will give us a board minutes, so we can discuss them as well. We can check them as well. So one estimation change is to be verified by commercial acumen, whether it is beneficial for the company or is just done so that we can have a better profit, so that we can list our company on the stock exchange. Now, moving forward to the next area, the company payroll was outsourced to a specialist payroll provider, 2005. Existing payroll data was copied onto a portable hard drive at the end of February. Payroll processed and delivered by hand to new company. Now, if we are outsourcing one of the company's main areas, that is payroll department, what are the risks here? The risk here is that my operation is going to someone else. If it is going to someone else, that means basically it is going out of the company. If it is going out of the company, that means basically now in this position, in this situation, the auditor will have limited access to the records, limited access to the control. The complexity is increasing, the work of the auditor is increasing. That means a higher detection risk, right? So a higher detection risk means that basically now we are going to be in a position where we might not be able to work as of we were able to do when the particular activity was in-house. Other than that, if the data is transferred manually to a portable hard drive and delivered by hand, there is a chance of data loss, there's a chance of corruption, there's a chance of damage. So increase the risk of loss of data. If data is lost, that means basically we are having high detection risk here. So detection risk when increased, that means basically our auditor has to perform more substantive procedure. This is a risk that is going to spread over the complete department, right? If one of the department's area or the department's complete data is missing, it will cast a particular problem on the complete financial statements. Payroll is one of the higher areas of financial statements. So first of all, discuss with the management that what will be the access procedures towards the payroll departments, the outsourced party. Then, if we are able to visit the payroll experts so that we can assess whether the controls are effective as of we want them to be, then we are going to do what? Check their experience, check their competence, check their systems that they are in, and we are going to check the opening balances of our current data with the previous old system so that we can say that the transfer has been done on adequate grounds. So these things will give us an indication that we are having all the data transferred on adequate grounds. The other party is competent, and we are able to check the data in accordance with the reliability that is present. Okay. Now moving on towards the next area. In May 2005, the website on an online training platform failed. Okay. Now the website and online training platform failed. This is a big risk, a reputational risk here. So leaving both the systems completely unavailable for 2 weeks. No course could be sold or accessed during the period. To maintain customer satisfaction, all customers were granted an extra month of access to their existing courses, which satisfied all the complaints. The finance director estimated that the company resulting losses and additional cost at the finance director at the particular situation was 250,000 and submitted an insurance claim for the amount of 50,000 in June 2005. The insurance company has indicated that it will take 4 months to investigate and reach a decision. The finance director included in current asset. Okay. Now this is a big issue here. Why is it a big issue? The big issue here is that the particular finance director has recorded a current asset. Now, is it a current asset? No, it is not. Has there been any reliance by the other party, the insurance company, that we are going to pay you? No, there is not. So if there is no kind of confirmation with us that we are going to be paid the compensation of 50,000, how can we record an asset? We cannot even disclose it, right? So in this situation, we have no confirmation. So the recognition of an asset is completely absurd. It can be only recorded when we have virtual certainty that we are going to receive the claim. So here we have a risk of overstating assets and our other income as well. So is this one of the areas of financial statements? Yes, it is. Then we are going to do what? Perform substantive procedures. So what we are going to do is communicate with insurance companies, insurance providers, and assess what is the particular position of the claim. Assess whether the claim is on virtual certain grounds or not. If it is not, then we will request the management that please remove the asset and disclose only, because as of this position, we have no confirmation that we are going to receive the money or not. Okay, so insurance claim is now this falls under IS 37 as well. Okay, now moving forward to the next area, the last paragraph of this case. This was a pretty lengthy case. Now, preliminary analytical procedure performed by the audit team. Analytical procedures are logical testings of the financial state. And so far in the current accounting year, gross profit margin has increased from 38% to 51%. Okay, but the operating profit margin has fallen from 12% to 8%. Now, is this a risk? Yes, it is a risk. Now, understand one thing, that what is the commercial acumen, what is the commercial thinking here? If our gross profit margin is increasing, what does it mean? Gross profit margin includes only sales minus cost of goods sold. Okay. Cost of goods sold is what? Cost of goods sold is all the costs that were required in production departments or production, such as overheads or direct labor, direct material, etc., etc. All are aggregated at one place, and that is the cost of the material. Now, if a production cost, if a production cost is classified into a non-production cost, it goes into operational expenditures. Okay, I'll just write it down for you guys so that you have clear understanding. COGS means production expense. Operating expense means non-production expenditures. Okay. Now, if I am having higher gross profit margin and lower operating profit, what does it mean? That means basically my production expenses are declining and my non-production expenses are increasing, right? So how can it happen? This can be happening due to misclassification of expenditures. An example, depreciation. Depreciation, if it relates to production, it is a direct cost to the product, right? It is an overhead that is there, right? So if we classify depreciation as of a non-production expense, it is coming in operating expenditure. If operating expenditure is higher, our operating profit is higher. So profit is lower, sorry. So one expense moving out of the cost of goods sold and going into your operating expenses. So this will increase a higher gross profit margin and a lower operating profit. So in this situation, our contradictory position will be there. So we can easily rely and say that our misclassification will be the agenda or the problem here that we can easily see. Okay, so this will result in a wrong decision making, in a wrong outcome that we are planning the audit for. Okay, so is this a classification of component of financial statements or classification of assertion that we can check? Yes, it is an assertion. So classification is the assertion that we're going to check. So substantive procedure are going to be applied here. We are going to operate or obtain the details of the breakdown of cost of goods sold and other operating expenditures. So identify that the cost expenses allocated in other production expenditures are correct and the cost of goods sold are true and fair and complete in nature. Then compare the classification and investigate any movement from the cost of goods sold to operating expenditures, such as depreciation or electricity bills, etc. So if there is a movement, that means we have to investigate that as well. Then we are going to request explanations for any reclassification so that we can get an idea that whether the reclassification has some commercial acumen or it is just done for any personal agendas to be clarified. So I believe that this particular question, in terms of the auditors that is having substantial marks for the first area, it is having approximately 16 marks. So 8 pointers are required. I have discussed approximately 9 to 10 points with you. So if you write any 8 points out of them, you will obtain very sufficient marks, very adequate mark, and you will be able to pass this particular question very easily. This is not at all a difficult question if you know accounting standards. Accounting standards are not optional for you, please. I'm telling you again and again, accounting standards are not optional. They are to be studied, they are to be kept in mind, kept into application as well. Okay. So if you know them, most of them are applied here. Now moving forward towards the next question, that is one for substantive procedures. Okay. Now, what is the question? The question says, describe substantive procedure the auditor should perform confirming the accounting treatment of research and development expenditure. So they are saying IS 37, IS 38 expenditure classification. We have to apply IS 38. Pirate should be applied here. Now, what is IS 38? I have discussed it. I'm just discussing it again. First of all, IS 38 has a condition where research and development is a position where research expense or research cost should be expensed out in the financial statements. Okay, after investigation, it cannot be capitalized because future economic benefit is uncertain. Now, development phase expenditure should be capitalized with the asset intangible in nature, and all the criteria once fulfilled, after that only we can classify them as a capital expenditure. Now, what are the criteria? Criteria are 6. Technical feasibility confirmed. We have adequate resources to complete the process or complete the product. We have an intention to complete. We have future economic benefit. We will have the ability to sell the asset or use it for future purposes. We have a reliability of measurement of cost. If these 6 conditions are accepted, if they are true and fair in nature, then we can perform substantive procedure on them and we can say that the cost can be classified. So if we are having question on substantive procedure here, I'll just tell you that the 6 conditions will constitute towards 6 substantive procedures only. It is very easy to write substantive procedure on this particular area. Okay. Now, first of all, if you have a question substantive procedures in terms of expenditure, there are multiple things in nature. There are multiple components of the expense. So first of all, the first thing that you should focus on or write as a point is obtain details or breakup of cost. Now, this should be the first point here. Why? This will give you indication that the examiner is seeing that, yes, you know that if the breakup is obtained by us, we can segregate the research expenses and development expenses on reasonable grounds. Okay. So first of all, obtain detailed background of all the research and development cost so that we can agree the general ledger and see whether the expenditures are recorded in accordance with IS 38 or not. Okay. We can inspect our invoices, payroll records, other supporting documentations to verify the nature of each cost incurred here. Then we can do what? We can review the project documentations. Now here, think feasibility report is one of the document that is there, right? we are checking the feasibility of the completing of the asset. So feasibility report is one of the document that we can check so that we can cast understanding or obtain evidence that the six conditions are satisfied or not. The first thing is feasibility report. Then if we are saying we will have a future economic benefit, then we will have a future economic financial statement or a cash flow statement, forecasted cash flow statement, that we can check whether the forecasted cash flow statement is there and is it prepared on reasonable grounds or not, right? Then if we have a pointer where the condition says that we have technical feasibility, financial resources, other resources available. So if technical feasibility is to be checked, we are going to check the internal management's technical reports, the financial position of the company, so that we can get understanding of whether do we have the technical feasibilities or technical resources or financial resources to complete the project or not. Then intention, how to verify intention? Intention means discussion. If someone has intention to complete a research, they will discuss it in the board, right? So minutes of the meeting can be obtained to identify the intention of the management, whether they are willing to continue or close the particular area. Then what can else can be there? If a expenditure is there in terms of your capitalized cost, so your double entry will be asset debit, right? Asset debit and cash credit, whatever the expenses, right? If it is coming on expenditure basis, we will have double entry on expense, debit, and cash credit, right? So check the double entries whether they are recorded on adequate grounds or not. Then check all the transactions done, that if the development is done on all reasonable grounds or not, all the criteria are fulfilled or not. Then assess impairment of the assets so that we can check the closing value of the particular new courses that we have, right? If you have capitalized the cost, the cost will be impaired as well. The market fluctuations are going to change the value of the asset as well. Other than that, what we can do is we can recalculate the capitalized amount. If recalculation is done, we will be able to have segregation between expenses and capitalized cost. And at the end of the day, the disclosure will be the last point that we are going to write, that disclosure of the particular expenditures in terms of R&D, whether capitalized or expensed out in accordance with IS 38. So with this, you can easily write 5 to 6 substantive procedure very easily if you just know what IS 38 has as a condition in it. So conditions, if memorized by you, you can easily write 5 substantive procedures, and you can basically get free marks from this particular question. Now, moving forward towards next question, what does it say? Now, the next area says, now this is a question that is coming in terms of corporate governance. Okay. Now, corporate governance is a question that is coming in on reasonable grounds. It is there. Okay. I can easily say that corporate governance, deficiencies in corporate governance and recommendations is a question that is coming on continuous basis. In section A as well, sometimes some of the questions are there, and section B as well, there are questions there. So you have to be careful in this regard that you are able to go through the corporate governance efficiencies, you are able to have understanding of independence, objectivity, concepts like that. Okay. So now let's read the passage. And the question is coming to the conclusion that we have to write 2 corporate governance efficiencies in Gomez plans and provide a recommendation to address each deficiency. Okay. 2 deficiencies to be identified and recommendations for those. Okay. Now the first paragraph that is given to us, it says, a director of Gomez company wants to improve their corporate governance. Okay. Now the current board comprises of 4 executive directors, one of whom is acting as chief executive officer, the CEO, and one as finance director. Okay. Now, please check the composition of the board. Check the composition of the board. The board should have majority. The BOD should have majority of NEDs. More than half should be NEDs here. Okay. So let's write, we have 4 EDs as of yet in the board. Okay. Now, next, what does it say? It says one of which is acting now. CEO is one of the person, one is finance director. Plans are in place to appoint a new company chairman from outside. That is a good thing because a chairman of the board should be independent party and a non-executive director as well. Now, the CEO's brother, who has several years of experience in online learning, has been suggested for this role. Now, first of all, I just repeated one point that the chairman of the board should be independent in nature and a non-executive party. Now, he is a non-executive party here, but is he independent? No, he is not independent. He is not suitable here. The first point comes in lack of independence of chairman of the board. CEO brother proposal is inadequate here because it says that the CEO's is brother is having familiarity threat here. He will lack independence here. He has a prior relation there. So the risk is that he might support the CEO with all the additions, all the recommendations, all the things that are there. He might be having a lack of independence, or he is having a higher lack of independence there. Now, if in the composition, you can also say that if the CEO is an elder brother and the chairman is the younger brother, the elder brother can dominate you as well, right? If the elder brother can dominate you in this position, you can easily say that the particular position is that you will have a lack of independence as well. So influence is the first part that you have to focus in. Okay, so influence will be the first part to focus in. If you write this, that the board of directors should have an on the executive party as a chairman of the board who is independent in nature. The CEO's brother is a close family to the executive party, so there is a higher threat to independence. Now, in this situation, there will be a risk that the CEO might be favored by the chief or the chairman of the board because he is a close family, and his decision might be biased in nature to benefit his brother, right? So this is a corporate governance weakness in this situation. Now, what should be the recommendation? Recommendation should be the non-executive chairman should be recruited externally using independent search agencies, not one that is familiar to us, and a competent, independent, and non-executive party should be chosen who has no links with the company, no family relations, no interest in the company itself. Okay, this ensures that objectivity is safe and the leader that is coming in is having the sole purpose of benefiting the company. Okay, number one. Number two, three independent non-executive directors will also be appointed in using executive search company to find suitable considerations. Now, again, the composition. Now we have, they're saying that we will hire three more EDs, three NEDs, that makes seven people. Is there a majority of executive directors here? Yes, there is. There is a particular executive director majority here that is a particular risk to the board. The board should have majority of non-executive directors or at least more than half of non-executive directors in the particular board. So this will constitute towards a corporate governance risk. This risk will basically impact the decision making where the executive parties will overpower the decisions of the board in terms of their favor. The executive parties are already in power. They are working in the company. They are the people who are checked in the board of directors. They are the people who are answerable in the BOD. So if they are of dominance, if they are having majority of the stakes, then that means basically they will take decisions that are favorable to them, not to the shareholders. This will result in a corporate governance weakness as well. Now, our recommendation should be that the board should have a majority of NEDs. Now, we should have at least four NEDs in the particular board so that we can cast independence. We can even challenge the executive directors, right? The chairman of the board should be excluding these four executive directors, non-executive directors that are hired. Okay, so four entities should be hired, and chairman should be a separate person, and this should composition should be maintained at least more than half of entities are present. Okay, now next area, what does it say? The next area says that these three NEDs together with finance director will create an audit committee. Now they're saying the entities will come in combine form a audit committee. Okay. Now the particular finance director will combine with our entities and become or form a audit committee. Now, first of all, is the finance director a person who should be included in the audit committee or not? No, he should not be. Finance director cannot be there in any of the audit committee position. The audit committee or the remuneration committee or the composition committee, all these committees should be independent in nature. Independence means that no executive party should be there in the particular audit committee. Not even the chairman of the board should be in the audit committee, right? So in this position, in this situation, the finance director should not be included in the audit committee as he has a self-review threat here and a self-interest threat here. He will not accept any decisions. He will not take any decisions that are in the hindrance of the company's interest, even though if they constitute towards frauds or misstatements. right? Audit committee has the purpose of what? Audit committee has the purpose of election of auditor, setting the remuneration of the auditor, filing the auditor, communicating with the auditor in terms of the execution of the audit engagement, and any significant deficiencies, any significant problems that are identified by the auditor, the audit committee communicates it to the board of directors, right? So if a finance director is there, it will lack independence, it will have a issue that the finance director will have self-interest and self-review threat. So reviewing the particular financial statements or the company's criticism will not be taken good by him, and it will lack the main objective of the audit committee. So the recommendation should be the audit committee should have only non-executive directors, and the finance director may attend the meetings, but he should not have any chance or any of the decision-making powers within the audit committee. And at least one of the entities should have a financial background so that he understands the financial statements or the financial components of the audit report. Okay. Now, the last thing, the chairman will also be expected to deal with communication with external stakeholders once the listing has taken place. So, is the board of directors chairman only the person responsible? He should not be the only person responsible. Every person who is performing the job should be responsible to make the decisions or discuss with the shareholders. If the chairman is not available, you will not communicate with the shareholders. That is not a thing that will happen. If the chairman is not there, he is out, he is not well, etc., etc., anything happens, then there is an alternative available. There should be an alternative available in which communication can be done on reasonable grounds to maintain transparency. So the particular recommendation will be the company should establish formal investor relation process, ensure transparency where the shareholders can raise their concerns, discuss the problems with the directors themselves, and the chairman will be there. But at all times, it is not the responsibility of him only. Okay, timely and transparency in communication will ensure that the particular shareholders are having trust in the board of directors. So with this, we have just read this small paragraph. We have identified 4 deficiencies. You have to write only 2. So I believe that this particular question is clear to you guys. And with this, the first question of our pre-scene, the 30-marker question is complete. Now I'll be referring to the chat box. Any questions you have can be referred in the chat box. I will be answering them. Okay, now let's read the second question, the question that is of 20 marks here. Now this first question that says, in accordance with ISO 315, identify and assess the risk of material misstatements states that controls are aimed within the components of entities, system of internal controls. Controls may be direct or indirect. Yes, they can be direct or indirect. Now, what is the requirement here? The requirement here is that we have to define direct controls and describe 3 examples of direct controls other than authorization. Okay, other than authorization, we have to define direct controls. What are direct controls? Direct controls are those controls that are designed to prevent or detect errors and misstatements within the financial statements directly, right? It can be such as we can have automation systems, we can have segregation of duties, we can have physical verifications, we can have reconciliations, we can have supervisions, etc., etc., right? So direct control is a control that is present within our company to directly mitigate or reduce the chances or eliminate the risk of having errors and material misstatements. Okay, now they have an immediate impact in reducing the risk. Okay, we don't have to take multiple other steps in terms of it. Okay, now moving forward, what can be the examples here? If the examiner is giving you or asking for examples, okay, you can read the passage as well. The passage will also give you some of the hints of the circumstances that are there. Okay, now let's read the situations, the passage, the paragraph. In the passage, if we see that the production department at Beats work as on just-in-time inventory. Now the computerized system is there, preset orders are there, the approval suppliers were all set up in the system 2 years ago as part of. Now here in this system, we have a computerized system that is checking the material dispatches of the orders that are there. Okay, so if we just read the statement again, orders for necessary materials are dispatched by a computerized system accordance with 2 preset order levels. The approved suppliers were all set up in the system 2 years ago as part of improvement in the integrated software. Now here they have what? They have a particular system where they are having pre-agreed suppliers. Is this a good control to mitigate the risk of having fictitious suppliers, suppliers that are going to provide a substandard material or not have a delivery issue or have pricing or any kind of discrepancies aware, right? Now, this is a good control. We can write this as a control. Deliveries are made within 12 hours by supplier whose invoice electronically when goods are dispatched. It items are put into production within hours of arriving at the warehouse. The team at the warehouse physically checks the goods received to ensure the goods being put in the production are appropriate quality or else the production will be held up. The goods received note is then produced mentioning that the time of delivery and the quantity of goods delivery and a copy of GRN is sent to the accounts and one copy is maintained in the warehouse. Now, is this a good control? Is this a good control? Yes, it is a good control. What are we doing here? We are reconciling our particular documentations here. We are comparing our GRN to invoices and physical assets, right? Our supplier invoices compared with our GRN, the goods that we have received. We're physically verifying that the goods that are there with us are delivered on time. The goods have adequate quality. They don't have any kind of quantity issues. They have no other problems within the particular company. There are no disputes as of yet. Physical verification of asset is a direct control that we have in terms of the situation. Reconciliation also done that a supplier invoices is basically sent to two departments where the GRN is compared with it, right? So comparison of documents, physical verifications are example of these particular transactions. Now, if we read the sales and dispatch system as well, Beats website allows individual to order goods directly and full payment is taken in advance. Currently, the website is not integrated into the control inventory. Now, this is a deficiency. We will focus on it in the next part. Now, therefore, inventory levels are not checked at the time when individual orders are placed. Beats detail customer undergo credit checks prior to acceptance and credit limits are set in accordance by the sales director. Is it a good control? Is it a good control? Yes, it is a good control because we are having predetermined a senior staff is allocating or assigning credit limits, and the particular customers are having a cross verification. First, the credit limit is checked, that is approved by the director, and then only their transactions are accepted or not. This will have an impact. Why? This will have an impact that we will have reduced chances of having bad debts. Okay. Now, these customers place their orders, though one of the members of the sales team who decides on sale discount levels. Goods are dispatched by a local courier, however, did not always record customer signs. This is a deficiency. Now, the proof of customer received over 12 months, there have been customer complaints about delay between sales order. This is a deficiency. Beat has investigated this and found that in each case, sales order had been entered into the sales system correctly but not forwarded to the dispatch team. Now, these are deficiencies. So, here three examples that I can easily see or relate to the passage is first of all, physical verification of the assets, reconciliation of documentations, the invoice and the GRN is compared in. This will reduce the discrepancies within the pricing, quantity, or quality issues. Then we have approval of transactions, right? Approval of transaction, credit limit is being checked. Then if a supervisor is approving sales orders, that means basically this is also a control that is present. A person approving any kind of sales order taken or matching the inventory to the dispatch notes is also a verification process through which we can say this is a direct control. Okay. So what is a direct control? Again, direct control is any control that mitigates risk directly and does not require additional steps to be taken. Right? It prevents, detects errors of material misstatement, and these are controls that are basically enhancing the chance of having a strong internal control system. So this is a very general common base example. If you are relating to the passage, it will be best for you because it will gain you higher marks here. Now, moving forward to the main part of the question, that is deficiencies identification. Now, the main part as of common, 5 deficiencies to be identified, advice, control, recommendations, and test of controls. Now, first of all, how do we write a deficiency? Number one, deficiency writing is very easy. For deficiencies, three things I'm repeating again and again that we should do. Number one, identify deficiency, identification, copy paste it from the passage. Second, explain why deficiency. And number three, impact on efficiency. Okay, now this is the identification, the process of writing a deficiency. Now, if you write a deficiency, now the second part is recommendation. Many people don't get the idea of how to write a recommendation or what is a recommendation basically exactly find us. So deficiency is basically identification of the risk, right? If you have identified the risk, our recommendation should be in two steps. Now, the first step is your thinking process. Second step is writing. Your thinking should be, number one, thinking should be that you should think what should be the objective of my control. Objective of control that I am going to recommend. Let's say if there is a risk of theft, my control's objective will be to reduce the chance of having a theft, right? So this is the thinking part that you have to write. Now, when you identify the objective of control, you can get ideas how to achieve that objective, right? So the recommendation can be based on the objective achievement. So here, if I say that we are trying to go for or trying to mitigate the risk of being theft or having a mugging with us. If I'm going to the ATM and taking money out, how can I reduce the chance of getting my money stolen? There are multiple chances. If I am having the main objective of reduction of the risk of having my money snatched from me, I will take extra people with me. I can hire guards. I will go at a place where there are higher people. I will not go in a place where there is low footfall or low people or it is dark there or at night, etc., etc. Right. So your recommendation should first focus on the control objective that you are trying to achieve. Then recommend a control, and the control that you have recommended, you can take a sample of it, check it whether it is effective or not in mitigating the risk you identified in the first part. So the three-step model, three-step systems is going to be helpful in the drafting process for you. And please remember one thing, don't try to memorize substantive procedures, audit planning procedures, or any areas of control deficiencies. Identify the process of how to draft them. Okay, this will immensely help you in your examinations. Now let's read the particular passage and see what is the deficiency that we can have. Okay. Now in the first paragraph, I have seen there are no deficiencies here, right? Deficiencies are coming later on in the passages. Now here, if we read the first passage, if we are going towards the identification here, in the first passage, I didn't see any kind of deficiency here. In the second passage, let's see. Deliveries are made within 12 hours by suppliers whose invoice electronically when goods are dispatched. Items are into production within hours of the particular goods are received. The team at the warehouse physically checks the goods received to ensure that goods being put into production are appropriate of quality and everything else. The good received note is then produced and the items delivery are mentioned in it and the copy is sent to the accounts department. Okay. As far as this place, we don't have any deficiencies. Now the deficiencies are coming later on in these three paragraphs. Okay. A Beats website allows individual to order goods directly and fully payment is taken in advance. Okay. Currently, the website is not integrated into your inventory systems. Therefore, inventory levels are not checked at the time of individual orders placed. So the first deficiency is highlighted in front of you. Very easy. Why? First of all, if the website is not integrated with your inventory system, now why is it a deficiency? It is a deficiency because if you are accepting an order, you don't know whether you have the stock or not. If you don't know whether the stock is available or not, you are going to face a situation where you will accept an order for inventory that is not existing, right? So this is the risk, and the impact will be that you will lose goodwill. The customer will be dissatisfied. The customer might go to another competitor. You will lose reputation here, right? So three steps: identification. Website is not integrated with inventory systems. Why is it deficiency? Individual customers order can be accepted without consideration, without looking at whether the inventory is available with us or not. This is the risk that the sales of non-existing inventory can be done. What will be the impact? The impact will be that we are going to have a system where the clients, the customers that are coming in will not trust us. They will not place order with us. We will lose sales. We will lose reputation. Okay. Now, the second step, that is recommendation. Now, how do I recommend them a control? Recommendation should be as of now, think what should be the objective of your control. The objective is that you should first check whether the inventory is available before taking an order, right? This is the objective of your control. So how should I achieve that? Now, to achieve that, it is very simple. Integrate my website with my inventory systems so that I can check the order in stock first and then accept the order, right? So integrate it in a way that the order is accepted only and only if stock is available. This is the recommendation. Now, if I have to check this, what can I do? As an auditor, I can have multiple things running. I can use test data. I can use a sample of the online transactions. I can do what? I can place an order online for a good that I know is not available right now, right? So if I input this test data, should the system reject my order? Yes, it should. If it does, that means the system is the that is as recommended is adequately implemented, right? And if it accepts it, that means basically it is not implemented efficiently. Okay. Now another thing can be select a sample of online orders and verify that it has the inventory available. It has the corresponding inventory available within the warehouses, right? And we have checked the inventory systems before the confirmed order has been placed, right? This can be one of the areas. Now, moving forward to next area. Next area says beats retail customer undergo credit checks prior to being accepted, and credit limits are set by the sales director. Now, this is a good thing, right? These customers place their orders through one of the members of the sales team who decides sales discount levels. Okay. Now, first of all, is the sales discount level to be decided by a sales employee or a senior member? The discount should be discussed by or affected by or chosen by the senior member, right? It is not the duty of a sales order clerk or sales employee, right? The sales team should not be authorized to give the discount. Why is it a deficiency? It is a deficiency because they might show bias. They might give their friends and family members higher discounts and people who are basically genuine customers not a discount, right? So in this situation, it will create an imbalance, a reputational loss, or a loss on customer as well, right? And a loss in a position of revenue as well because you are giving higher discounts to your friends and family members, right? This is a deficiency. Now, what should be the recommendation here? The recommendation here should be that the particular discounts allocation or the percentage of discount should be approved by the senior manager of the sales team or director of the sales team. Okay. This will ensure that the discounts that are given are on true and fair basis. There is no managerial bias here. If I want to test that, I can basically take a sample of the customers given a discount and check whether it was approved by or authorized by the senior manager of the sales team. Okay, so this is one of the efficiency that I can see. Now, goods are dispatched by a local courier. However, they do not always record customer signature as proof of customer receiving the goods. Now, what is the risk here? The risk here is that if the department that is dispatching the goods is not recording signatures or any proof of delivery, what is the problem? The problem is that the customer claim that they did not receive the good. The customer claim that the goods were stolen. Our employee ourselves, the delivery partners can steal the goods themselves as well. And the customer might not receive the goods, right? So on both the sides, if we look at it, that the customer might say that we have not received the goods, they might actually would have, but we have no evidence to prove it that they have received it. And the delivery partner might have stolen it, and we have no proof that the particular customer received it or not. In both the circumstances, it is a deficiency that we are having. Now, what will be the objective here? The objective here will be that our control should ensure that the customer receiving the goods should have a proof of delivery, right? The customer should receive the good. Okay, this is our control objective here. To ensure that, what should we do? First of all, have signatures given or signature taken on the good receive note by the delivery partner, or a modern method that is also used in Pakistan these days. Some of the organizations send a OTP code to the customer. So when the rider comes in, the rider cannot mark their goods as delivered until unless he writes the OTP in the message. This is the new method. We can recommend that as well. Or we can have a photographic proof. The photographic proof can be a particular situation where we have photographic proof of delivering the goods, but it is not useful in every situation. Why it is not useful in every situation? Because some of the customers might not want their picture to be taken. So this is not very effective way. The effective one will be signatures or OTP systems. This will help us ensuring that the particular customers are receiving the goods that they intended to receive. Okay. Now, how should we test this control? If I am having signatures, I will basically just inspect a sample of the delivery records and check the goods dispatch note or goods delivery note and see whether the signature is there or not. Or for the OTP, I will see if any of the orders have a missing OTP. If the missing OTP is there, I can verify whether the customer has received the goods or not by communication with the customers. Okay, so I can test these controls by these systems, right? Now, moving to the next area, over the past 12 months, there have been customer complaints about delay between sales order and receipt of goods. This is a deficiency because we are having a reputational loss here, right? Now, over 12 months, there have been customer complaints. Beats has investigated these issues and found that in each case, sales order had been entered into the sales system but not communicated to dispatch department. And this is a clear deficiency here, right? This is a clear deficiency here in the controls where the particular orders are not communicated effectively. So our control system is having a lag here in between, right? If the lag is present here, what will it result in? It will result in a situation where our company might not be able to deliver the goods on time. We will lose sales, we will lose our recordings of our deliveries, and it will be a miscommunication in multiple grounds. So our objective here should be of the control that we are trying to have a clear communication mode between the two departments of warehouse and the sales team. So establish a communication chain where the order, when once confirmed, directly goes towards the warehouse and they are getting an update on whether the customer has ordered the particular goods or not. Okay, or when to dispatch or not, an alarm coming up on that particular situation. Okay. Now, if I want to test that, I can basically see if I place an order and get a confirmed order. I can go to the warehouse and ask the warehouse people whether they have received the order for a particular name or number as of this date or any date that we want. Okay, so this is one of the things. There are some other things that I have identified here. Okay, that are a little hidden in nature. Now, first of all, if I see here that one of the things that were written in terms of credit checks, one of the things that were written in credit checks for customers, the data was for 2 years ago. If supplier list is for 2 years ago, does it mean that it is relevant? Can I ensure that it is relevant? It is a thing that is outdated. It can be outdated here. So in this situation, we can reasonably say that the data should be updated on annual basis or half annual basis, right? A supplier 2 years ago might show some of updates, some of the changes in its features, which may lead to a position where our decision making should be affected here. So the data should be updated on reasonable grounds. We might take decisions on obsolete data that might result in a misstatement in a financial statement, loss of revenue, or any kind of customer dissatisfaction as well, right? So our control here should be that data should be updated on annual basis, right? And our overall periodic review should be done by senior management. So our objective is to have updated data. So what can we do here is we can have a system in which we are evaluating that customer, the supplier list on annual grounds or half yearly basis or 6 monthly basis, so that we can update the list in accordance with our previous expenses or experiences and our futuristic approaches towards the customer. Okay, if I want to basically check this control, test this control, whether a particular review is done or not, I can inspect the records and check whether the master data was reviewed. Now, reviewing means there are updates, and for updates, I can use audit softwares to identify any kind of changes in the data system that are present, right? And if there are any changes, changes can be identified through samples as well. So there were in this question they have asked you for five. I have given you approximately 6 to 7 ones. So it was very easy for you to write these particular options, these particular situations, these particular chances of risk that we are having in internal controls. Now, only the approach is important here. If you identify the approach, you understand the approach of writing these controls, these efficiencies, it will help you a lot in terms of delivering the examination results. Now, many people know the answers. Many people, when they're reading this case, would have adopted the answer, but they might not be able to communicate it. So if communication is not done effectively, efficiently, then it will result in a failure in the examinations. So now I'm again referring to chat box for any questions, queries you have. So write them down and I'll answer them. Okay, now moving towards the last area of the pre-scene mock. It is mainly focused on 4 parts, and each part is going towards substantive procedures. So accounting standards are of key importance here. Now let's read the case. The first question says describe the substantive procedures to obtain audit evidence in relation to valuation of receivables. Now, if I read this word valuation of receivables, valuation receivables means what? Value of the amount that you're going to receive. Okay. Now, how does a receivable is valued? How is a receivable valued? Receivable means amount received. Now, our amount received can have a problem. What? Our receivable can have a bad debt, or in IFRS terms, expected credit loss. And IFRS 9 can be applied here. Okay. Now, IFRS 9 can be applied here. Bad debts is the thing that we are going to focus here. Valuation means that our receivable is to be written down. Now, what we have to assess here is that we have to perform substantive procedures that are going to assess or basically check whether the amount recorded in terms of receivable is true and fair or not. Okay. Now, let's read the passage first. What does it say? Red company has a material receivable balance owing from its customers. Plain company, during the audit, your team reviewed the aging of this balance. Now, first of all, one point here that commonly people would have thought is aging of receivables, but they have checked it. So you cannot repeat that point. You cannot repeat that point that we can obtain the receivable analysis or the age analysis of receivables. Okay. Now you have basically checked the receivable aging. Next, what does it say? During the audit, the team has reviewed the aging of receivables and found that no payment had been made from Plain company for 6 months. Okay, now from 6 months, Plain has not paid us any amount. And Red company would not allow the balance to be circularized. That means no confirmation can be sent to him as well. Okay. And instead, the management assured that your team that they will provide a written representation confirming that the balance is recoverable. First of all, written representation is not an alternative of audit evidence. So written representation will be taken, but it is a supplementary document, not a substitute of audit evidence. So if they are assuring us that they will give the audit evidence in terms of what we can say, in terms of a written representation, that is not at all acceptable in exchange of audit evidence. Now let's see the valid situation. Analysis of aging done here. We cannot send confirmation as well. What can we do? We can perform alternate audit procedures here. Alternate audit procedure includes, first of all, if we are not allowed to basically send a confirmation, what we do? We can basically, number one, check for subsequent receipts or any invoices generated from the particular customer. Now, within the year, we have seen that no money is received. But after the year end, is there any amount that is received by the customer? So if any amount is received, that means basically, yes, the customer will pay us. The chances of having a provision for bad debt is lower here. So first of all, subsequent receipts. Number one, subsequent receipts is checked here. Number two, what can be there? Number two, what can be there? If we are having subsequent receipts is going to verify us that we are having any money received from the customer or not. What else can be there? There can be other situations, other positions as well, such as correspondence with the customer. Correspondence with the customer means that has the company have any discussion with the particular customer, any history with the customer, any financial statements, past behavior, etc., etc., any evidence towards us that the customer will pay us or not. If the customer has a trend of paying in 6 to 8 months, that means basically he will pay us. There is no need for writing them down, right? If the customer has a pattern of paying within the in the first 3 months and they are not paying as of this date, that means basically there is an unusual pattern. That means accounts receivable should be written down in terms of their in terms of bad debts. Okay, so bad debt should be recorded here on reasonable grounds. Okay, now alternate audit procedures, first of all, subsequent receipts can be one of them, correspondence with the customer can be one of them. Now, what else can be there? We can first of all we can check whether the particular management has discussed it with the board of directors. If the amount is material, the BOD might have discussed it, right? If the BOD might have discussed it, that means basically this is a event that can give us audit evidence, right? There can be other audit evidences as well. Now, if in a situation, we are getting a position that the customer has not paid us yet, okay, should we write them down? Amount should be written down. Now, if you have to write it down as well, what is the reasonable circumstances on which we have to write it down? That is what we have to investigate it. Now, the main objective should be the valuation of the particular account receivable. What else can we do here? Now, we can have basically any kind of sales done to the particular customer or GDN or goods delivery note present within the particular transactions. We can check a sample of the transactions done from the particular customer. If a transaction is done within the last 6 months in which he has not paid us, that means basically we are having some kind of interaction with the customer. That means basically if he is communicating with us, if he is having business with us, that means basically this is audit evidence in terms of working with us. Okay, so check for sales, receipts, GTNs, etc. etc. What else can be there? Written representation by the management. If they are saying, then ask them to give a written presentation. This will basically give us audit evidence, but a weaker audit evidence. Okay, it is not a sufficient audit evidence, but it will be supporting the audit evidence that we have procured ourselves. Okay, then again, one thing else we can done is that we can have an analytical procedure performed. We can have a procedure where we can see if the particular company, if the company has had receivables last year that were higher, and is the receivable increasing higher than normal or not. We can also check if the customer had a pattern initially and whether the pattern is followed within this year or this is an unusual pattern that we can see. Logically try to understand the what is the activity happening. Okay. Now, all of this, what we are trying to do here is if we are performing subsequent receipts, if we are corresponding with the checking correspondence with the clients, if you're talking about board minutes, if we are talking about sales and GDNs, if you are talking about any kind of what we can say analytical understanding, what are you trying to identify? How much amount to write down in terms of a bedded provision? How much of a provision should be recorded here? If there is no communication, there is no sales, the board of directors have discussed it and they find that we might not be able to recover the money, then in circumstances we will write it completely off, right? So that this will be giving us a true and fair picture of the account receivable position that we have had at this year end. Okay, so you have to write 5 substantive procedures. I have given you 6 to 8 of them. Now, remember at all times when you're talking about substantive procedure, the first method of substantive procedure should be that number one, go for accounting. What does the accounting rule say? IS and IFRS, list the steps of IS and IFRS. It will help you immensely in forming substantive procedures. Number two should be identification of documents. But documents, what do you mean? Like, let's say in the non-current asset, we have fixed asset register, we have double entry books, we have general ledgers, we have sale deed, we have purchase deed, we have our depreciation schedule, etc. etc. So documentations can be the next thing that we have identified. Now, third things go for other areas such as physical verifications, transfer of the assets, particular assets, what we can say, transfer of assets, legal title to us, rights and obligations can be checked here, right? So last area is other areas or physical verifications. The first is accounting, second is documentations, and third is other areas. So when you're drafting substantive procedure, what should be the three things you should go for? First, what is the action that you're performing? Action means review, observe, check, inspect, etc. etc. On what document are you performing substantive procedure? On what document are you performing the action on? So action can be on fixed asset register, it can be on sample of sales in orders, GTNs, any kind of document that is present. So we are performing a substantive procedure, we are performing procedure on this document, and by completing the sentence, the complete substantive procedure will include one thing that is very important that many people miss is what are we trying to verify? What are we trying to do with this procedure? Okay, now if I want to basically inspect the purchase deed of the particular building that I have purchased as of yet. Why am I doing it? I am doing it, I am performing this substantive procedure to verify whether the asset has been transferred to my name, whether I have the rights and obligation of the particular building or not. Now, if I'm inspecting the bank statement, what I'm trying to identify here, I'm trying to identify the bank balance or any kind of discrepancies between the cash book and the bank balance. So what are you trying to achieve is the word, is the area that is going to gain you marks. It is going to gain you an edge. Okay. Now moving towards the next area, the next question, part B. It says we have to perform substantive procedure on a reorganization of provision. Or reorganization provision. This is, we can say, restructuring provision as well. This is reorganization provision. Now, first of all, what does reorganization provision mean? What is the accounting treatment here? It is first of all falling under IS 37, right? IS 37 it is falling in. Provision is contingent liability or contingent asset or whatever the amount is. First of all, what do we have to identify here? First of all, is there a present obligation upon us? Legal or constructive obligation. Okay, it arises with communication with the board or communication with the relevant staff who is going to be affected by the restructuring or the reorganization. Okay, if we have communicated our plan to the organization employees, other stakeholders, that means now we have a obligation upon us. Now, is it probable that we are going to have an outflow or not? If there is a probable situation where we are going to have an outflow, that means basically we are having future economic outflow and it is estimatable in nature. So it means we have to record a provision. Now, in this scenario, if you just read the scenario here, what does it say? Spring Company operates a chain of health and fitness clubs. The company recently announced a plan to reorganize its health and fitness club. This involves closing some clubs for refurbishment, retraining some of the existing staff, and disposing of some surplus assets. These plans were agreed to the board meeting and announced to shareholders. Now, if they were agreed in the board meetings and announced to shareholders, that means there is a constructive obligation. So obligation part is satisfied here. Now, activities including closing clubs, retaining staff, disposing surplus assets, billing a cost. Yes, billing a cost. And is it reasonably estimated that this cost is going to be there? The amount can be estimated here. Yes, it can be. That means basically the conditions of provision are satisfied here. So if conditions of provision are satisfied here, we are going to just check the conditions whether they are reasonably met or reasonably recorded or not. Okay. So in a situation, we are having a reorganization provision. So what do we have to do here is we have to investigate whether the provision is to be done on reasonable grounds. Now, if a particular communication is done within the board minutes, what can we do? We can review the board minutes and the shareholder announcement to confirm that we have a reorganization constructive obligation approved in front of us. We have a constructive obligation. This is what we have to verify. Now, when you read the case, you are identifying points from the provision kind, right? First obligation, verify the obligation. Verify whether the particular announcement is made and is it made in regarding to the restructuring clearly or not. Then if we are told that there is a cost, estimate supporting documentation for cost. Now, if we are taking a refurbishment, it would have a quotation from the supplier. It will have some other documentation as well, such as the complete plan of the restructuring that is approved in the board, right? So details of the particular estimated cost, the estimated cost report, the quotations are to be retrieved so that we can see that these costs are there and these are the costs that we are going to be having in the provision to be recorded as. Now, what can we do else is we can have a reconciliation done by the invoices that we have had, the schedules of management, and the amount recorded in the financial statements, right? Then in the assumptions, if let's say if we are having a provision made, let's say employee training or closure dates, etc., etc. What are the assumptions the management has made in terms of the cost to be incurred, right? If I am saying that my employees are going to be trained with 1 million rupees, so how do you understand 1 million will be coming there? What are the assumptions made in terms of the expectations of closure date? Any kind of lack of that you have kept, any kind of provision that you have kept in terms of the delays in the completion of the stage, any penalties that you have kept, etc., etc. So all of these things are to be taken into account, right? Now, what else can be there? We can basically have a breakdown of, or we can recalculate the reorganization provision cost, right? so that we are getting the complete calculation, we are getting the evidence that this is a particular situation, the particular cost that is going to be there. Okay, now understand one thing, that when we are talking about provisions, when we're talking about reorganization provisions, we are only going to take into account the costs that are unavoidable in nature, right? Unavoidable in nature. If we are closing the particular uh, clubs for refurbishment, it will have a cost, we cannot avoid that. Can we avoid retraining cost? Yes, we can avoid retraining costs. If we don't train employees, it is just simple thing. We are not training employees. There is no requirement for it. There is no obligation upon us for it. It is a avoidable cost. If it is a avoidable cost, that means basically now we can see that we can review whether this avoidable cost is not included in the provision, right? The restructuring provision says that you are required to record only the provision of amounts or transactions or events that are unavoidable in nature. If they are unavoidable, you have alternative, you will not record a provision for that. Okay, so for future provisions, futuristic provisions, only amounts that are unavoidable are recorded in it. So training or retaining of staff can be avoided here. Then other than that, we can have adequate disclosures to be present within the financial statements in accordance to IS 37 to basically relate towards the contingent liability or provision that we are having done here. So I believe that everyone is clear on this particular area of how to go about the thinking of the question. Now, if you don't understand or if you don't remember the reorganization or restructuring provisions, then revise that once, you will get some more points here. Okay. Now, moving forward to the next area that says we have to perform substantive procedures and appropriate audit evidence in relation to depreciation of summer company. Depreciation. Now, again, depreciation accounting. First of all, accounting. What does accounting relate here? Depreciation has two to three things. First of all, rate or type of method of depreciation, useful life. This is also estimation. Third thing is double entry. Fourth thing, fixed asset register adjusting depreciation or recording depreciation, right? So these things can be just focused. I have not read the case as yet, but I can easily say that these things are going to be impacted here or going to be referred here or should be referred here, right? So in this situation, let's read the depreciation paragraph. Summer company incurred significant capital expenditure during the year on updating production facilities in its main factory. The finance director has proposed that the new plant and machinery should be depreciated over the 10 years using straight time method. Previously, the plant and machinery has always been depreciated over 8 years using reducing balance method. Now there's a change in the estimate. If there's a change in estimate, first of all, we are going to identify what is the reason behind that. If a capital expenditure is there, that means the assets value is increasing, right? If the assets value is increasing, so the cost should be capitalized. So the useful life is to be determined. Depreciation method is to be determined. The pattern is to be thought. Now, many people don't think that when we're deciding a method of depreciation, what should we think? When we're deciding a method of depreciation, we should look about the recoverability of the amount. If an asset is giving us a stable return over its useful life, a stable return, so we should use straight time method of depreciation. If our asset is having a higher return in the first year and the return is reducing each year, we should go for reducing balance method in these circumstances. So method of depreciation varies upon the amount or the percentage of return that we are getting or the pattern of return that we are getting. Okay. Now in this situation, previously we had reducing balance, now it is straight line. What is the key considerations? First of all, is the 10-year useful life adequate? Is changing the method of depreciation justified or having any commercial acumen or is reasonable in nature? Or is it just done so that we can show our financial statements in a better of position? That is what we have to obtain here. We have to understand here. Okay. So first thing, what should we do? If we are saying that we have capital expenditure and the cost should be capitalized on the asset, we have new things. What are we going to do? We are going to inspect the documentation of purchase. If you have purchased something and it has a capital cost, documentation is taken. Purchase price is going to be verified here so that capital expenditure can be correctly recorded and the qualifying depreciation can be adequately recorded. Now understand one thing as well, inspection of purchase documentation can also lead to some more evidences. If I'm checking the purchase documentation, One point will be that I will check the invoices, the contracts, the delivery notes, the ownership transfer of the asset for the new plant and machinery, so that I can verify the capital expenditure incurred and what is the amount that is qualifies to depreciation. Second thing, what does it help us in? Invoice will give us difference between capital expenditure and revenue expenditure, right? What I'm trying to verify here, that whether it is a capital expenditure or revenue expenditure. So revenue expenditure should be expensed out in the income statement, and capital expenditure should be capitalized here. So the auditor should examine whether the costs are correctly capitalized or expensed out in the income statement, so that we are not charging incorrect amounts of depreciation in the income statement. Now, third thing, assessment of useful life. Assessment of useful life, on what grounds or what technical feasibilities or technical specifications are we suggesting that the 10 years useful life should be done, right? If the 10 years useful life is done, what is the thing that we can see if we want to determine whether the useful life is adequate, correct or not? One thing is can be checked is the replacement cycle of the business. If the business has a replacement cycle of an asset for 10 years or 8 years, or the industry standard is 10 years for this new machinery, we can identify the commercial acumen behind them. Okay, so the auditor should review technical specifications, manufacturer guidance, industry benchmarks for the new machinery, so that we can check whether the proposed 10-year depreciation, the 10-year useful life, is adequate in nature or is having reasonableness in it or not. Okay, now next thing what can we do is depreciation method or rate, depreciation method or rate. So the auditor should assess whether the straight line method is showing a true and fair picture of the asset, or the reducing balance method would be a better option for us. Now, how should we determine this? This determination is, as I discussed, with the concerning returns that we have. If returns are higher in the first initial years and reduce in the later on years, we should use reducing balance method. If it is stable over the useful life, that means basically we should go for straight line method. So using this assumption, using this knowledge, we can basically check which of the depreciation method gives us a true and fair picture in terms of this position. Then if we have recorded depreciation, can we recalculate depreciation? Yes, we can recalculate depreciation. We can recalculate depreciation over a useful life. The asset is having a value. We can divide the value and record it. What else can be there? We can check our general ledger that our depreciation is having double entries recorded in it on adequate grounds or not. What else can be there? We can check our fixed asset register, that our asset is written down by the level of over the by the amount of depreciation, or fixed asset register is updated in terms of completion of the recording of expenses of the depreciation there, right? This can be also done. And last but not the least, the disclosure can be there, which will basically give you in the adequate disclosure in accordance with IAS 16. The user financial statements will know that the useful life or the particular depreciation method has been changed. This is a requirement of changes in policies and estimates in accordance with IS 8. Okay, so you have to write just 5 to 6 financial procedures. I've given you 7 to 8, so it is very easy for you to write these particular answers in. I believe that this is clear to you guys as well, and we'll move forward to the last area, the last question of this pre-scene mock. Now, this is a question that is going for going concern assessment. Now, let's read the passage. Autumn Company is also currently conducting the audit of a prominent client for the year end 31st March. Farmco is an established pharmaceutical company. Okay. And has lately seen rare growth in the level of competition. Now, competition is increasing, indicator of going concern. Demand for its products is significantly declining, again indicator of going concern issue. Farmco needs to invest 7 million in plant and machinery and want to borrow it from a bank, but they cannot agree on suitable terms. So, wanting to get a loan but cannot acquire a loan, again indication of going concern problem. Now, therefore, it used its overdraft facility, which carried a higher interest rate. So, interest rate increasing, that means difficulty to pay it back. Now, consequently, some pharmaceutical suppliers have been paid much later than usual, and some of them have been withdrawn from credit terms. Now, if the suppliers are withdrawing from credit terms and they're saying you will pay us in cash and take the money on paying the goods only then, and if you're paying them late, that means basically this is an indication of going concern issue. We have a liquidity issue here, right? Meaning the company must pay cash on delivery. So this is a negative impact on the company's reputation. As a result, above the company's overdraft balance has overgrown substantially. The overdraft balance has grown substantially. We are having cash flow issues. We are having a very big problem here. So our examiner is asking us explain audit procedures that the auditor should perform in assessing whether the company is a going concern or not. Okay. First of all, if we are having cash flow issues, it is prominently said that we cannot get financing from the bank. We are using overdraft. Okay. So first of all, what we are going to identify now, if I want to check whether the company is a going concern or not, first thing I can check is whether they are having any sources of finance in the future or not. Sources of finance is first mentioned is bank here. If bank is there, that means basically we can inspect the correspondence from our company with the bank that whether they are getting their overdraft renewed or not. Okay. Alternatively, we can also discuss with the director that if they have any discussions with any other bank or with this bank only, and can we get our loan passed in the shorter period or not. Okay, so we have to understand this as well, that whether we have contacted any other bank for loans for finances. If we have that basically contacted with them, the director will give us a communication. So we will get an indication that yes, the cash flow issue is resolved here. So we can first, if I identify the problems, first is cash flow issue. So cash flow issue can be identified or checked by the auditor by inspection with the current bank that whether the overdraft is renewed, or discussion with the director whether we can acquire some finances or loans from any other banks. Number one. Number two, what we can do is the sales and revenue prospect. So sales slash demand. Higher competition means more people entering the market. More people entering the market means difficult market conditions, and sales also reducing. That means basically this will give us a indication of if we assess this, that whether we are going to have a higher sale in the future or lower sale in the future. Can we check whether we are able to run our company on reasonable grounds or not? Yes, we are. So the auditor will inspect the company's futuristic, or we can say forecasted cash flow statement. Forecasted cash flow statement, so that we can identify or we can check whether the particular company is having reasonableness of operating or paying off their debts in the longer run. So examine forecasted cash flows so that we can evaluate the reasonableness of the management assumption that they will be able to pay off the loans in the longer run, or at least in the next 12 months. Other than that, we can check the post year end sales of the company so that we can get an idea of what is the position of these sales in the company. Is it increasing, decreasing, or at the same level? This will also give us the indication that whether the company is going to be able to run in the future or not. Okay. Now, next thing that was the issue was creditors not giving goods on credit. If creditors are not giving goods on credit, what can we do? We can basically inspect or check any communication with the suppliers. Suppliers communication, if in this situation, if you see that if they're communicating, they're checking any communication with supplier, it is mentioned there in the case that the suppliers have told us that we are only going for cash. So now what we have to identify here is we have to identify that what will be the response of the board here. So the response of the board can be checked from minutes of the meeting, right? So minutes of the meeting can be assessed where the directors are having discussion with the particular board of director, the chairman of the board, where they have any replacement strategy or suppliers or not. If they have a replacement strategy, that means basically they can get goods on credit terms now, right? Or review any impact of supplier credit changes if the supplier has given us a position where he is saying only pay us in cash. Can we buy goods in cash or not? This will give us an indication whether the company is having liquidity in their operations or not, or whether they will be able to run their operation on cash basis or not for the foreseeable future. Okay, what else can be done here? What else can be done here? Now, there's a tool known as in financials management that is known as sensitivity analysis. What does this mean? Sensitivity analysis basically means that the forecasted statements that we have gotten, we can test them. We can test them how we can see whether the increase in the interest rate or a decrease in the interest rate, how will it impact our profitability. If we see that our increase in the interest rate will reduce our profitability substantially, or our cash flows or the net present values of our cash flows are going to be near to zero or can go negative, that means the company is in a very volatile situation. If the company is in a very volatile situation, that means basically we are having a very sensitive position where we can get an understanding that yes, these are the positions where the management is worried, or the management should be worried that we are not going to be able to have a going concern position. Last but not the least, if we are having forecasted cash flow statements, now we're auditing the company, right? So for the auditing of the company, we are going to be for the next 3 months after the year end. So can we have the company made interim financial statements? We can ask the management to prepare interim financial statements, and we can cross verify our forecasted cash flow with the interim financial statements to identify whether the particular assumptions that we have made are they being fulfilled or not. By checking all of these things, we can reasonably estimate whether the company will be a going concern in the foreseeable future or not. Okay. So with this, we have ended our pre-scene exam. All the three questions, all the areas in section A is was done yesterday. Section B is done today, and the complete area is done. So I hope that you were able to get some better insights on these particular questions. And if you have any other queries, I am available on the chat box right now and the WhatsApp group as well. So I'll be now referring to your chat box for any of the queries that you have, and I'll be answering them shortly. So as we have completed a pre-scene for today, I believe that you guys have had some better insights on the pre-scene and will be having a better position of writing the answers as of next date. I'll be sharing a complete drafted answers with you on the WhatsApp group. And if you have any other queries, you can ask them on the WhatsApp group that is free, available for all, and any other areas you can contact me privately as well. So hope to see you on the WhatsApp group for any queries, and hope this session has helped you in the longer run. So with this, I end the session. Thank you so much.